Well, good morning, good afternoon, good evening. Welcome to Breakout Trading Answered, where we talk about all things breakout trading. And boy, do we have a great show for you today. We've got a lot of great stuff planned. So welcome. Now, if you're new to the show, my name is Andrew Swanscott. I'm the host of the show. And joining me, we have breakout trading specialist, hedge fund manager, and all-round good guy. Welcome, Tomas Nesnidal. Welcome.
Thank you very much. Thank you, Andrew. And hi, everybody. We love breakout trading. You know that already. And we're super thrilled to be here with you tonight because we're going to talk about what? Breakout trading.
Yes, exactly. We've got some great, we've got some hellos in the chat as well. G'day, Chris. Thanks for joining us. Dominic, Hugo, Dave. Hello from Auckland. And Khalid, welcome everyone. And Sko, g'day, Sko. I'm glad to see your name here today. So, this is the second part in our 5-part series that we're running towards the end of the year. We're running every second week. So, the first episode was 2 weeks ago now, and we talked about how to finish your year strong. And well, how do you think that show went, Thomas? Do you have any feedback?
Yeah, actually, I was pretty surprised. We had a good engagement. We had brilliant audience, great question. I really enjoyed that. We had a good strategy to deconstruct. I think we had a pretty good feedback as well. I know that we received some questions after the show. Also, the turn-up was pretty nice, and I noticed that the show was quite popular on our YouTube. A couple of hundred views already. So I think it's great, and you guys, that's why we are here. We are here for you, because of you, to help you with your trading. So please do not be afraid to bring up your questions, send them to us, and we're happy to talk about breakout trading stuff. That's what we live with every single day. That's what really we're so enthusiastic about every single day.
Exactly. And I'm just looking in the chat, and we've got people from all around the globe. We've got James is from Wales. Oliver, g'day, Oliver, is from Germany. We've got a hello from Sweden. We've got Auckland, Australia. Amazing. So we've got people from all around. I know in some of those, greetings, Rob from Netherlands. G'day, Rob. So I know in some of those countries, the timing is a little bit challenging. It's 6 a.m. here in Australia. So, it's great that everybody's made the effort to turn up today, and we're going to deliver something really great for you. So, just talking about the questions that you mentioned, Thomas, we had a bunch of questions that came in after last week's show. So how about we get straight into those and get those done, and then we can talk about our 6 top tips for breakout trading today. So what do you think?
Fantastic. Let's do it.
Okay, let's get into it. So I'm going to just put up on the screen, we've got some slides here just to make them a bit more visible. So this one is from Sebastiano. This was put in the YouTube comments. Hi, Thomas. You said you prefer average win-loss ratio greater than 1.8. My question is, are you measuring this before or after adding slippage and commission costs?
Okay, great question, Sebastian. I do usually consider this before adding slippage commission costs, but I think both ways are fine. I'm probably a little bit more aggressive here, way more conservative approach would be including your transactional costs.
Okay.
So both ways are okay.
Excellent. Let's go to the next one. We'll fire through these pretty quick. Let me just go. Here we go. So this one is from Jan. Regarding the first, a great first episode, I'd like to ask you a question. How do you manage to have more TradeStation sessions running at the same time? I would guess you need to have all except one in offline mode and one in live or sim mode. Moreover, are you able to manage running live and sim at once in one TradeStation account, or do you need to have more separate accounts?
Well, you can have 2 different separate instances on your on one account, TradeStation account. So if they haven't activated you the second instance yet, just send them an email and they will activate you the second instance. So you can have 2 instances on one TradeStation account. Then, of course, you can have one of your instance can be offline, exactly as you suggested. And then the other thing is that I have more accounts. Not I, but in our hedge fund, we have more accounts because we continuously need more accounts for our team. But by default, you can have 2 different independent instances per account, and that should be enough for 99% of traders to work with. And then, of course, you can take one instance offline and have 2 online instances and work with the third one offline. So yeah, that's how many traders do it as well.
Yeah, excellent. We've got another one here from Jan regarding strategy development. I would like to know how long it takes you to develop good enough strategy for using in your portfolio when you start from scratch. This is a great question.
That's a great question, Jan. Honza. We say it's a Czech name. We say Honza. So Honza, this is a great question. It depends whether you do it semi-automated or you do it fully automated. We do have a full automation, and it really depends on a market. There can be markets which can be super challenging, and even with 1 or 2 servers going through automatic design and development process all the time, it can take weeks for really difficult markets, but for some easier markets it can be a couple of days. So if you want me to develop a strategy within 1 week, high quality, robust strategy with easier markets, I can definitely do that. So it's between 1 and more weeks.
Yeah, this is a great question, actually, because we're going to talk about how this is possible as one of the points we discussed today. So that's more details coming soon. Honza, did I get that right? Honza?
Yeah, Honza, yes.
Honza.
Yeah, Honza,
Okay.
Exactly. Honza.
I feel like you're turning me into a Czech, slowly but surely.
To Czech,
okay.
Yeah.
Okay, next one from Honza. And finally, I would like to ask you how you deal with a big number of iterations when optimizing strategies according to swing add-on. Even if I fix some variables, I still get tens of thousands of iterations for one strategy. Do you have any other tips how to fix this?
Well, again, Honza, 10,000 iterations, 20,000 iterations, it's quite all right. It's reasonable, because a couple of years ago, that was something we couldn't even think about, like 20,000 iterations on my old 2-core CPU. 8-10 years ago, that was something out of question. Now we have very powerful machines, so 10,000-20,000 iterations is not that bad. I do not have any specific advice how to keep them low, because it's really case by case. In general, in our hedge fund, we do not use second time frame. We use just 1 time frame. That already simplifies the number of inputs. That means the number of iterations, and sometimes you just try to keep your strategy simple. Try to work with filters with 1 instead of 2 input parameters, and just stuff like that. Like, you need to play with that a little bit. I don't have one uniform easy answer. It's just a matter of practice and playing a little bit with different setups.
Yeah, excellent. All right, is that the last question? I'm not sure. Let's see what's on the next slide. Okay, one from Jose. What improvement on portfolio performance can we expect by mixing breakout and mean reversion strategies? Is it worth the effort of developing this new kind of strategies?
I feel like that's almost a question for Andrew, but that's a brilliant question. And Jose, the answer is definitely. And that's like, it's almost like a dream combination, because if you can develop good mean reversion and breakout strategies, and you can put them together, you can get a lot of extra leverage. And I think that's also a good question for you, Andrew, because I know that you got some serious experience with mean reversion.
Well, yeah, I think there's a how can I explain this? It's kind of like a fine line between the two, because I think there's definitely a lot of value in being a specialist in one type of strategy or style. And as we mentioned in the very first issue of the Empowered Trader newsletter, you wrote some great content about specialists being better than generalists. So I completely agree with that. But then there's obviously a benefit by having mean reversion and breakout trading. So I think if you're starting out, just pick one and stay with it and become really good at that. I think that a lot of traders kind of get stuck when they're trying to jump around the beginning, or they're starting out and they're jumping around between different styles, and nothing ever really sticks because they don't give it long enough. So I don't know, Jose, where you are in your trading journey, but if you're just starting out, then I recommend that you just pick one for now and work with that for a couple of years at least, and see how you go with that before you look at other styles. Very well said. Actually, you Andrew, pretty
cleverly, wisely got me ready for the today what for the topic of today's episode. Yeah.
Excellent.
And
Is there
it
another
even
slide
wasn't
here? I'm
your
not sure.
intention.
Yeah.
No, I think we can go directly to
Okay.
what we have to talk about here today.
Yep. Okay. So the topic of today is six top tips for algo breakout trading. I need to get my mouth working this morning. It's still a little bit sluggish, like the rest of me. But so we're going to be talking about. You've got some great points to share with us today, Thomas. So how about we start with tip number one?
Yeah. Okay. So let's talk. So here is the thing. I said we're breakout trading specialists. We love breakout trading, and Andrew just mentioned one very, very important thing, and that is if you want to be successful in trading, you really should focus on one direction at the beginning for a couple of years only. Is the specialization that at the end of the day will really move you forward? That it's specialization that will get you further than anybody else, that will move you faster, help to move you faster than anybody else. So you need to stay with one specialization for the beginning if you want to succeed. And if that thing should be breakout trading, which is the case for us, then my first advice would be work with a conceptual approach, work with a model. That's what I call model. For me, it's a conceptual approach. And if you want to succeed, the thing that you must not do is just jumping from one thing to another. Just like a lot of traders, they do these horrible mistakes that they're just goofing around. They're just fiddling with all the different components without knowing what they are doing, without following a certain protocol or model or whatever, and they're basically just like this totally random approach which doesn't lead anywhere. If you want to really start creating great strategies, you need to think conceptually and model wise. And in breakout trading, I have a very simple model. It's nothing complicated, but this model is basically the very essence of my work, the very essence of my hedge fund, of my private trading, of everything. And it goes like this. The good breakout model is just about, and this is very fundamental, and I'll keep probably repeating this in upcoming episodes again. It's a simple model where we work with some point of initiation. From this point of initiation, we calculate some space where the breakout is supposed to occur. Then we set some appropriate time when this breakout should occur, and then we add a couple of filters, and that's the entire model. The beauty it is that now we have a model, and because we have a model, all we need to do is just changing components of that model, playing with different components, but we are working conceptually. We're not just jumping from one thing to another. We're already focused. We're already following one straight line. This is a proven, extremely powerful model working on any time frame, any market, any trading, anything that's tradable. And now you really have something solid, like strong foundation in your hands that you can work with and start moving forward. So tip number one, you need to have conceptual approach and work within this conceptual approach as the opposite of just jumping from one random idea to another.
Yeah, that's a good point. And I think some of the other benefits of having a model is obviously that you can automate it because you've got a defined structure. But
exactly,
I think if you look at like there's some software out there that can build strategies automatically, and basically it works just by throwing a whole bunch of random crap together and seeing what spits out the end. And I think the reason why those type of approaches don't work is because they don't have a framework or a model that's based on research and data to say that this model works, and then you can add random things over the top of it to see what happens. But without that structure, I think you're kind of flying blind.
In my eyes, it's something like when you are sitting in a big garden or garage, and in this garage you have a lot of car components, and you're supposed to assemble a car from these components. So you're just trying to fit different pieces together. But then somebody comes to you and he gives you a plan. He tells you this is what it should look like. Like John Ford, what is his John? He comes up and he gives you his plan how to really build that car, and then you have a strong foundation. You can start building your car from these components very quickly. You know what to put together, why to put it together, and it makes all the difference in the universe because you are following something structural and conceptual, and that will really accelerate you tremendously.
Yeah. We've got a good question here about the model in the chat from Sco. Let me put this one up. Does space in your model usually refer to a price range?
Yeah, correct. The space is how far you are from the point of initiation. So your point of initiation can be, let's say, close of a bar, and your space can be certain measurement of a space calculated from this point of initiation. Usually it is certain multiple of average true range. So very simple, nothing complicated.
Yep. Okay, and a question from Philip here. Does the model work on stocks on end of day or end of week trading? Does it also, sorry, I read that. Yeah.
It works end of day, end of week. It works with profit targets. It works with alternative exit techniques. It works with anything. It's a universal model. It's just up to you what components you will plug into it, but it works with any kind of exits. And in fact, especially for stocks, end of day and week of day work very, very well.
Yep. Okay. All right. We've got a couple of other questions here, which we'll save for later. So Dave, we'll come back to your question a bit later on, just so that we can keep moving through these 6 points. So first one is model. Now, I think I need to go to the next slide, don't I? Let me see here. Okay, so the next point goes to this question from Rogerio. Thanks for the question, Rogerio. What are the best markets for breakout systems?
Yeah, excellent question. So this is tip number 2. Just like a lot of people, they approach this whole idea pretty wrongly. So when I talk to people and other traders, they're like, do you trade crypto, right? Like, why should I trade crypto? Just because everybody else seems to be playing with that and losing a lot of money on that. And a couple of people winning a lot of money on that doesn't mean that I need to play with crypto. So the key question is, what is it you want to achieve in your trading? And if you are like me or Andrew, then obviously the answer is we want to achieve a stable income, right? Like we want to have a good distribution of our wins. We want to have stability because we're pretty much making income here, and we need to substitute our 9-to-5 job income. So consistency is the key. Now, how do you get to that consistency? Like, Andrew, give me an answer. Are you going to get to consistent results with trading crypto?
I'm no crypto specialist, but I've seen the markets going up and down, and I'm not sure if people are making regular income from that. There probably is, and there probably isn't.
Exactly. It goes up and down, and I know people who made money in crypto, who lost money in crypto, but everybody says it's super volatile, it's volatile. You need to have some really strength nerves to trade crypto. If you want stable income, the question is not which market, but it is what are the markets that you can get which are as low correlated as possible, because if you want to get a steady stream of income, you need uncorrelated markets. It doesn't matter whether it will be 2, 3, 4, 5 totally uncorrelated stocks or 2, 3, 4, 5 totally uncorrelated ETFs or futures markets. I do prefer futures markets because we have a lot of markets there which are totally different categories. Like in futures, we can trade grains, indexes, energies, metals, meat, like just name it. And that means we already have this possibility to go with totally independent markets, which are not dependent to each other, like with many stocks. And that means if we have independent markets, we can create low correlated strategies. And the more low correlated strategies we have on more low correlated markets, the easier it is to create a strategy or portfolio, not strategy, but for portfolio for a stable income. So my second tip is, do not focus on what everybody talks about. Focus on markets that will give you fundamentally different correlations, so you can create low correlated portfolio. By the way, Andrew, you put me on the whole screen right now, and I noticed that for some reason my image was a little bit delayed. I don't know if you saw me like this or it's just on my side. So I apologize. I don't know what happened here.
You're looking good to me, so let's just keep going.
Okay,
I think
great.
it'll be fine.
Okay,
Yep.
okay, thank you.
So that was point number 2. So we've got the first one was model, and the second one was markets. Now we've got another question here, which leads nicely into point number 3. Let me pop this one up on the screen. It's another question from Rogerio. What are the best time frames for breakout trading?
Right, that's another brilliant question. So okay, so once you focus on low correlated markets, and it's really up to you which you pick. Like pick one from indexes, one from energies, one from grain, one from meat, one from metals, and you already have fundamentally different structure of your portfolio. You already have something that can give you low correlated complementary systems that can produce to more stable income. So now you need to talk about timeframes. My experience with timeframes is very simple, and that's my tip number 3, which is, first of all, stay away from super fast timeframes like 1 minute, 3 minutes, 5 minutes. There's a lot of noise, and it's really difficult to fight with this noise. And you can definitely create beautiful overfit equity curves on your back test data with 1, 2, 3, 4, 5 minutes time frames, but they do not hold up well in the future because these are very messy, very unstable. There's a lot of noise. So if you want to create serious strategies, start thinking higher, 10, 15, 20, 30, 60, even higher time frames. Personally, I like going 30, 60, 90, even 120. I do not trade dailies, but dailies could be a good solution as well. But from all my testing, these 60, 90, 120, even 240 minutes chart just perform with breakout trading better than just dailies or anything less than 10 minutes. So that would be my tip number 3.
Yeah, and an interesting point on that one as well. When I was, I come from a end of day trading model, I guess, and switching to intraday, I always assumed that the shorter time frames will be better, but that's actually not the case. In my research, I've found you can even do day trading with like 120-minute bars, and it works out quite nicely. So I think that that does actually make a difference in the type of trading results that you get by the bars. That you use.
Yeah. We came to the same conclusion with day trading. Like day trading, anything below 15 minutes, we don't even touch.
Yep. Okay, so that was number 3, time frames, and we'll keep moving here because I can't wait to get to the strategy review we've got after this. So we'll keep going. So we're on point number 4 now, and here's another question from Rogerio. Rogerio was on fire on this day. What are the best periods of the day for entering a position for intraday trading?
This is very, very simple answer. There are differences, but you need to figure out. And the approach I do is just I take the whole session and I split it between 3 to 4 different equally long parts, and then I just see which is the best session. It depends on market. It depends on strategy. There will be differences. Some differences will be really, really big and profound. So you need to test this individually, but there will be differences, and it's worth testing. Just be careful not to restrain your periods of a day so much so your sample size gets too low. So for 10 years of data, you still should have anywhere between 50 to few hundred trades per year. So you should still work with a reasonable sample size, and also your time of the day restriction should be set accordingly to keep a good amount of trades in your sample size.
Right. Okay. So you're talking about the length of the session there, right? Which is what you call a time template.
Right. Correct.
Yeah. So what time does it start and what time does it end? Which is, I guess, more clearly defined in stocks than it is in futures. So that's can make a big difference, especially in futures. If sometimes you started a half an hour after the regular trading hours, you miss out on that first bit of a move, which can be very noisy. So even adjusting it by a little bit at the start and end can have a big difference on your results.
Yeah, that's a great point as well. Yeah, you're talking now even about something more advanced, which is basically time templates, right? And with time templates, you can really make another huge difference. And as Andrew said, like the first 15 minutes or 5, 10, 15 minutes can sometimes be super messy and super deceptional. So it's a good idea to also, on top of using different times of a day for your entries, to just add this layer of different time templates. Sometimes it's just enough to cut off the first 5-10 minutes. Sometimes just last 5-10 minutes, and you can already have a significantly different result. So that's another great point, and definitely a good tip. Like, you need to play with this and see what you can come up with.
Yeah. So the next point is a bit of an extension from what you were just talking about there. What are the best time filters?
Time filters. Well, there's only one time filter, and again, that's just you take your whole session and you split it into 3-4 parts, and then you just see what is the best window time length where you fit well. There's nothing more complicated than this. Just no reason to overcomplicate it. Just like this simple time filter, just try 3-4 different equally long part of your regular trading session and see where it sticks. Or maybe sometimes just see where it doesn't stick. Okay, so sometimes you take the opposite approach. You just have a look at where you get the worst results, and you just do not trade that particular part of the day. And that's another great approach that works very well.
Yeah. It's because I think what you're talking about there is, you can see in some markets there's a very different, I guess, behavior between how the markets go in the mornings, and then over lunchtime they're a little bit different, because maybe people have gone down the pub for lunch or whatever, so there's a little bit less liquidity, and then in the afternoon you can have another different behavior again. So if you're recognizing those and leveraging those to your advantage, it can have a big difference in the I guess the results you get at the end of the day, right?
Absolutely. And we also need to remember that despite the fact that we are algo traders, there are still probably millions of discretionary traders in markets. And these traders, they do go out, eat as well. And very often, and I see this when I was in New York and Chicago, and I visited the key future exchanges, I saw this personally, that really traders, they do go outside and they do have their lunch during the regular lunchtime. So there's no surprise that during this time we have lower volume, we have lower liquidity in many markets, because it just reflects the usual nature of a human being, and that exactly has got this kind of impact on trading sessions and specific parts of a trading day.
Yeah. Okay, so that was number 5, time filters, or the T segment is what you like to call it. So for this 6th point, I wanted to ask the question myself, because when you start building breakout trading strategies, you can often find that at a basic level you get a lot of you get a lot of trades, and they often have low average trade, and they're a little bit poor quality. So how do you go about consolidating that into a better set of trades? How do you select them further?
Right. So of course, in the model we need a filter, right? Like that's part of the model. Not only we need some point of initiation and space and time, but we also need a filter. And filtering is the best way, and it's a necessary way that we get rid of these low quality trades and all this crap. Now, I have a couple of approaches when it comes to filters. It's very easy to overcomplicate strategy and layer up a lot of filters on our basic idea, and then get overfit or overoptimized crap. So I basically I like 2 different approaches when it comes to filters. So first approach is that we need something like a basic filter, which ideally is highly related to the essence of breakout trading. So when you think breakout trading, the essence always will be volatility. So any kind of volatility filter, when you compare volatility today's volatility with yesterday's volatility. Any kind of volatility filter works perfectly with breakout strategies because that's part of the nature of breakout strategies. Or also price patterns filters. I like these comparison between different close opens. These can be very good filters as well. Or even some trend-related filters work very, very well, like ADX or DMI, because again, that's part of breakout essence. The second approach, like when we still have too many trades and low average trade, and we still have so much of a noise, the second layer I like using, first of all, I love using filters with which do not have any optimization inputs. And we developed a couple of them, and we already shared quite a few of them in the Empowered Trader, in some of the past Empowered Trader issues. So these are very powerful because they basically have low risk of overfit and over optimization because they don't have any optimization inputs. Or sometimes I put very advanced techniques on top of my strategy, like smashing falls, breakout strategies, where you can really assess different and pinpoint and assess different moments of timing, and then work just on one very small part of your strategy and on the timing of strategy. But the point is, you always want to keep it rather simple, because we always can get our strategies overfit pretty quickly and easily. That's why having minimum input, minimum optimizable inputs for the main filter, which will be around 2, and ideally no optimization input or just one optimization input for the second filter, and ideally the second filter could even be on a higher time frame. That helps as well.
Yeah. Okay, excellent answer, because we had a question in the chat from Rakib about what indicators and patterns are preferable for breakout trading. So I think your answer there went into a lot of detail. So I hope that answers your question, Rakib, and thanks for posting that one in the chat. So from my calculation, that's number 6, right? Was that number 6? Yeah. So before we move on to the strategy review, which I can't wait to see what we've got in this show, let's do a quick summary. So the first tip was you need to have a model. The second one was you need to be selective with your market. Third one is the time frame. Fourth is the length of the segment, or we talked about what's it called, time templates. The fifth one was time filters and T segments, and that's really about determining the behaviors of the markets in certain times of the day and adjusting your strategies to that. And the sixth one was filters. So how did I go, Thomas? Did I pass this time?
Yeah, you did pass. You did pass. And also, it's quite important to understand that each of them is very powerful individually. So if you only, let's say, focus on your model for the beginning, that's already a big leverage to your future success. So each tip can give you pretty good acceleration and leverage.
Excellent. All right, so let's move on now to the strategy review.
Okay.
I can't wait to see what you've got lined up this time,
Yeah,
Thomas.
yeah.
I love this part of the show.
Let me bring up my
share your screen.
Yep. Yes. Let me just do it. So this strategy comes from Rob. I know that Rob is on the show tonight. And Rob is part of our BTA Elite community. Can you see the screen?
Yep, let me just pop it up on here so we can all see. Here we go. And you might need to zoom in a little bit like we did last week.
Actually, this is the same setup. Yeah, okay. That's the same setup we had the last time.
Right.
So Rob, he's a very hard working guy. He's making incredible progress, learning incredibly fast. He's building some very serious business when it comes to his trading, and I have no doubts that he will be tremendously successful pretty soon already with his business. And he sent us his YM strategy. But what's really great, he also sent multi-market and multi-time frame validation, which is something which we didn't have last time. So it's really great that we can now go deeper when it comes to strategy assessment. And this assessment definitely will not be the same like we had last time, because we will have the next layer and depth of multi-market and multi-time frame validation. So let's start with the strategy itself. This is again a compiled out of sample equity curve. So for out of sample compilation, brilliant. I really love that. On top of that, it does already include commission and slippage. So that's even better. We have very nice sample size over 10 years. We have nearly 800 trades. So far, so good. Fantastic. When we go to performance summary, we immediately see that it's a long strategy only. So it's a long strategy. There's a long bias, which is okay in indexes, because in indexes we have a long-term long bias, and it's okay to have a couple of just long bias index strategies in the portfolio, although it should not be a majority. It should be just minority, just few of them. And if I look at the key parameters, so profit factor 1.31 in my eyes is just great. Sample size almost 800, it's fantastic. Average trade after commissions and slippage around 80 on YM, it's a good one. Absolutely, I'm okay with this one. Then we have this average winning trade versus average losing trade ratio, which is 3.62. Wow, Rob, I don't know how you did it, but that's incredible. But it's for the cost of low win percentage, which here it's 27%. I'm all right with that, because in breakout trading we can have strategies with a pretty low win percentage and very high reward risk ratio, and I would definitely have a strategy like this in my portfolio. Just one thing very important to understand: you always want to be somehow balanced. So you, on one hand, you will have a couple of strategies which will have low winning ratio, winning percentage, and very high reward risk ratio, which is fantastic. It's almost 4-1, which is phenomenal. But on the other hand, you will also want to have some strategies with rather higher percentage profitable, 60-65%, and a little bit lower reward risk ratio, which is something I talked about in the previous episode, so I will not go to this topic again. You can watch, everybody can watch the previous episode. And then, of course, you want to have these strategies in between, which will be just the majority of breakout trading strategies, which will have usually the winning percentage somewhere around 40-45%, and reward risk ratio will be somewhere 1.678 to 1 to 2, somewhere there, which is usually the majority. So definitely you should not build your entire portfolio just on strategies like this, but it's a great addition. It's a good thing to have a strategy like this in a portfolio. When it comes to profit drawdown ratio, we are talking about 60K and 10K drawdown close to close. That's quite low for my taste. I prefer higher. I would prefer 8-1, ideally 10-1, but 8-1, it's the minimum. 6-1, it's pretty low. So if I would already at this stage, how I would think about this strategy would be, if I'm running a portfolio of, let's say, 30-40 strategies, I'm okay to have one strategy like this, or 2 strategies, 3 strategies like this there, which are a little bit out of a normal, talking about this win percentage, a very high reward risk ratio, and kind of a lower net profit drawdown ratio. So I would keep them in a bigger portfolio, but I probably would not create my first essential 5 strategies portfolio with a strategy like this. But the foundation is good and I like it. Let's now have a look what the rest of the validation looks like. Give me just 1 second. I need to share different document here from Rob. So I'm getting back. Okay, it's ready and sharing my screen right now. Okay.
We need a drum roll.
Let me.
Here we go.
Can you see it
Let
now?
me just one moment. Here we go. Yep. You might need to zoom. It's quite small. Can you zoom that document or not?
Yeah, I can. Let me try.
Thank you.
Any better?
Yeah, that's better.
Yeah.
Thank you.
So now what Rob really did is that, first of all, he did a multi-time frame validation. So his original strategy was developed on a 60 minutes time frame, which is this time frame, and he passed that strategy through 90 minutes, which is here, and 30 minutes. And this is so far so good. This is quite phenomenal, because we see that the strategy works easily on 30 minutes and 90 minutes. So we kind of have here like this nearest neighbor validation, right? Like we want to try this in the between, which is 60 minutes, but we already know that we would not fail on 90 minutes, neither we would fail on 30 minutes. And it is super strong validation, and it's really, really good. And so far, I'm loving this. However, I need to say that this is secondary validation. The primary validation is always on a different market within the same sector. So we're talking about indexes, and we need to validate primarily on different indexes to see how potentially robust that strategy could be. This is secondary. Even if this looks super nice, which does right now, I'm not so preoccupied by this until I see what the real multi-market validation is. So Rob created a couple of multi-market validation. So first one is on NASDAQ. And we need to when we talk about multi-market validation, we need to understand one important thing. Some parts of the strategy are not really normalized. That means that they will behave a little bit differently on different time scale. Price scale, because each market's got a different price scale, and unless we have universal or normalized filters or other conditions, we naturally have to see differences with different price scales. And for example, YM's got quite different price scale from NQ, so there needs to be a difference just by its nature. So that's why with the multi-market validation, we're not so preoccupied about a perfect match of the original equity. That's quite unrealistic. What we want to see is that the strategy on a different market is still capable of making progressively new highs, like repeatedly making new highs progressively, like having still this tendency and power, especially during the last, let's say, 3-4 years, to go after new highs. And that's the important sign for me, rather than the smoothness of the equity curve, which I said cannot match the original quite often. Sometimes it can, but not always, because of the different price scale. So in this case, I really, really like the validation. This is not intended to be traded on NQ. This is just a validation. And we do see there's progressive, strong tendency to go after new equity highs during last 2-3 years. So this is a very, very good confirmation. And I like that. I like this one. But one is not enough. I like at least 3, sometimes 2, but at least 3 different markets within the same sector. So we have 1. Let's see if we can get 2 more. So second one, we have EMD. This is crap. Like we can, immediately cut this off, like discard this. We cannot count on this. This looks horrible. Let's have a look on ES. ES is great. A progressive, strong tendency towards new equity highs, especially during last 2-3 years. Again, we have a difference here at the beginning, can be because of different price scales, because of different behavior 8 years ago or 9 years ago. I'm not so preoccupied about what was happening 8-9 years ago. Since then, last 8 years, we can see that it's really progressively making new highs. So very, very nice validation on ES. And then we have 2, and then we have RTY, which is E-mini Russell. And again, this doesn't look good. This is like quite a failure, especially during the last year. So I would disqualify this. So out of 4, we passed 2. 2 is not good enough. 2 is like, it really didn't pass my threshold. Now, what I would do, I have to say, in general, I like this strategy. It's got a lot of good things, and I'm especially tempted by the high reward risk ratio. So there are a lot of good things about this strategy that we need to take into consideration. And sometimes, sometimes it's difficult to create a final decision because although we can be just a little bit less from the ideal, we still know that we have something promising in our hands. So in this case, what I would do and what I would not do, again, and I said this already 5 minutes ago, if I would have a portfolio of 30, 40, 50 strategy, and I would just have 1 or 2 or 3 strategies, which would be on the very edge of my strict criteria, I'm okay with that. I definitely, even with 30 strategies portfolio, I would put it there because there's a lot of benefits, a lot of nice things about this strategy, and I would trade it. Whereas if I would be developing my first portfolio, 5, 6, 7, 8, 9, 10 strategies, I would not include it into my core portfolio. I would put it aside, and I would probably let it, trade, paper trade for a couple of months, and maybe get back to it in 6, 7, 8 months. But I would not include it into my very first portfolio because this is great, but you can do even better, especially with the multi-market validation, which again is more important than the multi-time frame validation. So that's all.
Excellent. That was a great assessment, Thomas. So thank you very much for that. It's always interesting to see what types of strategies other people are building and the results they're getting and how you think about assessing that. So that was great. And so I just also want to mention...
Thank you, Rob. Thank you, Rob, very much for this strategy. Thank you. Yep. And you're doing really great job. So I appreciate this strategy. And this one is a good job as well.
Yep. And if anyone wants their strategy to be reviewed, then just send an email to support@fedtraderacademy.com and we'll let you know what info we need, and perhaps we'll be assessing and featuring your strategy in the next show. So something to look forward to. So we've got a couple of questions in the chat, so maybe we'll quickly go through those, and then we're going to get to your motivational quote because it's your pick this time. I picked last show. So just scrolling up through the chat, there was a question from Dave, which I'm just trying to find. But here's a quick question here from, I don't know what the name is, the Phantom. What fitness functions do you like to use?
I like TradeStation, Index, and Net Profit. These are the only 2 I use.
Preference to which one? Do you think one works better than the other?
Yeah, TradeStation Index works better, and even Andrew confirmed that in an independent study which he did.
Yeah. Okay, so here is a question from Dave. It's a 2-parter, so I'll just pop them up on the screen and read it through. So in order to get automation up and going, would you suggest which of the options in terms of mini breakout versus swing versus something else? The second part would be best to start off with to get the process running end to end, or is it pretty much all of a muchness? So I think the question is where to start.
Where to start? Well, always start with the simplest thing you can, and I again, if you want to start very simple, the simplest way right now is to start with end of day or end of week exit. It used to be end of day exit, which was more efficient. Now it seems to be the end of week exit, which is more efficient. So this is like no optimization, very simple exit, and just with this exit you can start building a lot of simple swing strategies with this breakout model. So I would just focus on strategies with end of week exits and try different point of initiations and filters. And that should quickly give you your first strategy, especially on indexes, should be super easy. And once you have your first strategy, you already have your first experience, you're in the game, and then you start building up on this with more complexity, different variations and stuff like that.
Yep. Okay, we got a follow-up question from the fitness function. It's from John. What is trade session index?
TradeStation index. It's a
TradeStation
proprietary fitness function built in TradeStation, so you can only have it in TradeStation. I don't think it's any secret. It's quite simple calculation. I don't remember what it is. You would have to Google it on Google, but it's a fitness function built by TradeStation. They implemented it into their platform, and it's a simple calculation, but it's a very powerful fitness function.
Yeah, it's definitely available on their website. So just do a search, and the formula's there. It's not a secret formula. Okay, so here we go. A question from, I think it's Yurka. From your research, do you have some statistics about what number of robustness level 3 type strategies survive in 2 or more years? This is a great question.
Yeah. So first of all, Andrew, you pronounce it very well, Jirka. I think your Czech is improving quite significantly.
I didn't roll my R though, did I? Do I roll my R? Jirka. That's
Jirka. No, you did it great. Like Jirka and Honza, you're just exceeding my expectations tonight.
Okay, excellent.
So Jirka, this is a very simple question. We all our research shows that the highest efficiency of breakout strategies is somewhere between 12 to 24 months, but it usually peaks around 18 months. So we barely trade strategies for longer than 18 months. I wouldn't bother to trade even robustness low strategy for longer than 2 years. Like in 2 years, I would recompose my entire portfolio in 2 years. That's with fresh new strategy. There's no point on sticking on strategies for longer than 2 years. I would do it even sooner, 1.5 years. That's what our research confirmed. That's where the efficiency peaks usually of breakout strategies.
Yeah. So I think in the breakout masterclass, we actually did a coaching session on this, didn't we, Thomas? I think from memory. Yeah. So just go into the portal there, and you'll see it as one of the codes. It's probably the most recent one, I think. We did a few months ago.
No, that was one of the first, I believe.
Yep. Yeah. Okay. Let's keep moving. We've got a few more questions here, and we're almost out of time. So this one is from Rakib. Another question from Rakib. I read in an earlier blog from Thomas that it's possible to design 900 plus breakout strategies using a combination of filters. Is that too high? How can we design a few but consistently profitable breakout strategies?
Well, you know, this is quite a complicated question, and I'll probably go deeper into that in a different episode. The real question is why you want to create hundreds and hundreds of strategies, and it's very easy because you want to create a portfolio which will be, on average, as low correlated as possible. And you would be really surprised how difficult of a task that is. If you think that you can create a portfolio with about 10 or even 0 average correlation between 5 to 6 strategies, that it's easy. It's really difficult. So even to create a portfolio with 5 or 6 strategies, which give you average correlation between 0 to 20%, which is where you want to be if you want consistent incomes, you will need probably a couple of hundred strategies to pick from, because a lot of strategies will give you higher correlations, and then you also want to combine different filters, different time frames, different markets. So it really is quite difficult, like to create a low correlated portfolio, and it does need a substantial number of strategies. And that's something that a lot of traders do not understand, and they are scared by the idea of creating a lot of strategies. But once you have your automation in place and model and all that stuff, you can definitely create hundreds and hundreds of strategies and then create really, really robust, high quality portfolio. I can't imagine assembling even a small portfolio with less than 100 strategies. Even if I have to assemble 5 strategies portfolio, I would need probably 100 strategies to do it well, to have the luxury of high quality selection and put everything together. So it really fits and creates a high probability of stable and well distributed income.
Yeah, I think those numbers, when you hear them initially, they're very high. Like creating hundreds of strategies sounds very overwhelming. But the model that you've developed and the way the smart code is created and with automation, that's actually very doable once you get those pieces in line. And we've got people in the Breakout Masterclass and the Elite program that are creating thousands of strategies. So while it does seem a little far-fetched initially, it's definitely achievable with the right pieces in place.
Absolutely.
Yeah. All right, let's move on to another question. You're just talking about portfolios, which is great because Khalid has a question. Welcome, Khalid. How many strategies would you include in, say, a 100K account? And how much minimum dollar amount would you need to add each additional strategy?
100K account, I would probably trade somewhere between, let's say, 8 to 14 strategies, probably around 12. It really depends how much. It depends on your drawdown tolerance. Usually the tolerance is about 20%. So we're talking between 8 to 12 strategies. How much? Well, that's a difficult question. We again would have to do a couple of calculations and see what your drawdown level is and stuff like that. But probably after each 8 to 10K, you can add another strategy.
Yep. Okay, we'll do one more question here in the chat because this is a great question from Ludwig, and then we'll move on to the motivational quote. So let me get this one up on the screen. Why do we backtest over 10 years or more if we only expect 2 years lifetime? Maybe a strategy working today did not work in the past. Great question. What would you say to that, Thomas?
Maybe a strategy working today did not work in the past. Okay, I see what you mean. How do you know? We have to work what we have, and what we have is a backtest. And what we have is we need some good sample size. We need to know that a good, potentially good strategy is defined by that good sample size. So you need to create some sample size to even, consider you have a chance that you have a good strategy. So for that, you need history. What is the other way? What is, to me, this is a very rhetorical, a very theoretical question, because what other approach you have, whatever chance you have to get a good sample size, to get 10 windows of out of sample data, there's no any other process how you can achieve to get at least stuff that you need to have to put together a strategy that at least have a chance to work in the future. And that's okay that it works only for 2 years. And as I showed in the walkthrough of Rob's strategy, I do in the final assessment, I do put a lot of emphasis on last 2-3 years. But in a sense, there's no other way. That's what we have. That's what we work with. And I'm not, after 15 years in trading, I'm not aware of any other different approach that would give me statistical significance and validity that I need to create a robust trading strategy.
Yep, good response. I just want to sneak in one last question because it's from Arik, so and it's a good one. So, Arik, Thomas, if you lease a strategy on Striker, would you modify it or totally scrap it after 18 months and replace it with a similar strategy?
This is a tricky one because I have to admit we do have some strategy which run even 36 months and they do keep performing well. I would definitely look how much that strategy performance deviates from 18 months ago. And if it's still within the same boundaries, it's okay. Just keep it for a couple of more months. Some strategies, this is on average, some strategies will survive probably 4 to 5 years. I've seen strategies survive even 8 years, but that's an exception. On average, it's 18 months, but if after 18 months, your strategy is within all your parameters, boundaries that it was 18 months ago, just stay with that for a little bit while. It's totally okay. And then stay with that for another 6 months and reassess it in 6 months again, and you will see.
All right,
good
excellent.
question, Arik.
That is a good question. So that's it from the chat. Now, I think our final thing is your motivational quote, for the show. What have you got for us? Let me put it up on the screen.
I think it's in the slide.
Yep, there we go.
So the motivational quote that I picked for tonight is wealth flows from energy and ideas. And that's really important because I share with you conceptual thoughts and conceptual approach and conceptual framework, but now it's up to you to start filling these with ideas. And that ideas need also energy, and that energy needs to come from your desire to succeed. So if you have a true desire to succeed, you do already have all the energy in the world to come up with new, fresh ideas and start testing them within the framework and model that I share with you. And that already should really fast track you towards success. So that's my quote. I'm crossing all my fingers to you guys. Great questions, and thank you very much for being with us tonight. We enjoyed that, and again, really, really good questions.
Yeah, I like that quote. Actually, it's going to be tough for me to beat in the next show, but I'm going to beat it. I'm sure I will. So we'll see how that goes. So just quickly a bit more about this energy and ideas. So for people, if they want to know what the next step is. So if you want to be introduced to Tomas's breakout model in more detail, then you can go to the 14-day breakout. Oh my God, I've just forgotten the name of it. 14-day breakout strategy challenge.com. I think, is that right? 14-day breakout strategy.
14-day breakout challenge, no, without strategy, just 14 in letters, 14 days breakout challenge.com.
Here we go. I'm going to put it on the screen. There we go. And then,
it is strategy. You were right with strategy. Okay. Yeah.
My coffee is just kicking in, so I need a bit more time. And so if you've been through that program, there's other things you'll see in the dashboard, like the Breakout Masterclass, or just ping an email to support at Better Trader Academy, and they can help you out. And also, if you've got any questions or comments for this show or for future shows, then you can also either post them on the YouTube channel, and we review those, or email support at bettertraderacademy.com as well, and those will be filtered to us. And also, don't forget, if you enjoyed the show today, please give us a thumbs up on the video and hit the subscribe and bell button so that you're notified when we release new content and new events. So our next show, Tomas, let me just check the date here, is November 16th, right? So more details for that will be coming out via email, or if you're subscribed to the YouTube event, YouTube channel, then the event will pop up and let you know. So any closing words, Tomas, before we finish up for today?
Yeah, guys, we have 3 more to go. Okay, so take an opportunity of our time. Send us your questions, strategies to validate. We have 3 more sessions to go. So we want to be here for you, with you, and do the best we can to really support you and give you help and our hand. So thank you very much for being with us tonight, and happy trading.
Let's finish up with a couple of thank yous. There's one here from the Phantom, because there's no name. So whoever you are, thank you for your feedback and comments in the chat today. We've got one from Sko. Good to see you, Sko. This one is from Tomas. Thank you, guys. Who we got here? Dominic. Thank you. Our pleasure, Dominic. Gus. Thank you, and be well. We've got a thank you from John in New Zealand. Then, wow, there's a lot here. Yurka, thanks for that great question, Yurka, and I hope I got your name correct. Ludwig, thank you, great show. Oh my goodness, I can't keep up. Khalid, thank you. Okay, all right. And Arek. So thanks everyone for joining us today. It's great to have a community here to discuss trading, and thank you again, Tomas, for sharing your insights. And we wish everyone all the best. Catch you again in 2 weeks' time.
Mm-hmm.
Cheers.
Happy trading.
Bye-bye. Happy trading.